Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, August 2nd, 2013. And in this video, I'd like to do a quick overview of the markets, looking at the S&P 500 and NASDAQ 100 using their tracking ETFs, the SPY and the QQQ. We're going to start out with the SPY on the weekly time frame, and you'll note on my charts I typically use different color-coded trend lines to identify different patterns and sub-patterns within those patterns or whatnot. And in this case, let's take a look at these orange trend lines. You have this upper trend line and this lower trend line, which really make up either a contracting channel or a wedge type pattern. And that actually goes back for the last couple of years, all the way to 2011. So this, as we can see, prices have been wedging higher, making new highs, clearly making a higher high at this point where we're at today than we were a couple of years ago back in early 2011. However, the RSI and the PPO, which I will often use in lieu of the MACD, it just does a better job on longer term time frames. But both the RSI and the MACD and the PPO, I'm sorry, are diverging. We have what's called flatline divergence on the RSI, meaning that prices made this peak back in early 2011 and just recently made an equal peak. So the RSI failed to make higher highs, confirming these higher highs in the SPY. So thereby is diverging, and the PPO is slightly downsloping over that period of time. So that's divergence on the weekly charts. And something to note, I often talk about how divergences can be burned through at times. You know, divergences in themselves are not standalone sell signals or buy signals when we have the positive divergences. But from my experience, once again, they more often than not play out. And I would say, goodness, this is a rough estimate, but probably 90% of the time they play out for at least a tradable correction. And by tradable, we're talking, percentage pullback if it's negative divergence of at least 2, 3, 4, 5%, and often a lot more than that. One other thing to keep in mind is that the move following divergence, whether it's positive or negative divergence, is often commensurate to the scope of the divergence. In other words, if we're looking at a 15-minute chart with divergences that are built over the last few days, then that's going to lead to a counter move, whether it's a correction or a bounce, that's probably measured in hours to at most maybe a couple days. Now, when we have divergences on a daily chart that's, let's say, been building for 3-4 months, that will more likely lead back to a correction measured in weeks. At least several days, and more often than that, weeks. So again, the length and duration and scope and intensity. We can have a more steep divergence. This isn't very steep. In fact, this is only flatline divergence, so this is barely divergence. But again, it is divergence, and that does at least warrant some caution and tell you that the momentum is waning on this move as prices continue to make higher highs here. And enough on that. Let's just take a look real quick at the previous divergences. I will take an arrow here and mark. Now I have a blue line drawn, as you can probably see here, just below this orange line, and I didn't add. There could be a third line added here. What I'm looking at is this first peak in the RSI, and then we had this lower peak here. In fact, we even had divergence here. Let's draw this. Let's do this a little easier. I'll put these lines up right now. So we had negative divergence here, negative divergence here. By negative divergence, I mean prices went on to make higher highs. And what happened after that? Well, we had a correction. And prices correct. The next divergence took place, let's see, we had this peak. The RSI came up. Let's take those previous lines off so this isn't too messy here. Okay, we had another peak in the RSI, a lower peak. Oops, wrong toolbar. Sorry about that, folks. Trying to learn these screen draw tools here. Okay, there we go. Divergence from there, against prices making higher highs, And as you can see from that point, we had another correction. So it's pretty simple. Again, here's a peak, another peak in the RSI that were lower than that original peak. So that's the blue line drawn here, and that led to, from this point, this correction. So my point is, all of these negative divergences did play out for a tradable correction. Now, these previous or past divergences were burned through. That correction doesn't have to go on forever. Prices have made higher highs, but we continue to diverge, and we continue to diverge on a much longer scale. Now, these are multi-year divergences that have been put in place and confirmed by the RSI rolling down off that last peak as well as the PPO. And if we also take a note here, prices have now moved higher. We just made a higher high versus this recent peak here in the SPY. And if you take a look at the RSI has failed to do so. In fact, it's considerably lower. So in the shorter term, there's some divergence here as well. Now, this is going to show up better on the daily chart. We'll get to that in 1 second. Let's just take a look at one thing here. I wanted to look at volume on this move. That's something that's really been of concern, where prices go on, they're making higher highs. We just had a higher high or new high in the S&P yesterday. And let's look what's happened since we had this breakout. Now this line back here, here's the previous high in the S&P all the way back in 2008. So this was a major technical breakout here. And so far, from a pure price perspective, it is bullish. What we see here is a breakout. This line here, I'm zoomed in a bit, but this was the 2008 previous all-time high in the S&P. So we had a breakout, a back test, which is healthy action. When you have such a move up, you can't expect to break out, especially being so overbought, and just continue to run up forever. So from a price perspective, this is bullish action. The pullback to back test those levels and then continue to move higher. So that is bullish. What is of concern to me is this breakout was not accompanied by above average volume. In fact, the only above average volume bars we see here are the selling days. If you look at the red bars, and lately, especially on this push up since that back test, where you would expect a lot of buyers to step in, if this was a genuine breakout that has legs and will likely, we will likely continue to build on, that is not what I'm seeing. What I'm seeing is a noticeable drop off here in volume. Now, it is the summer months, the summer doldrums, so I'm not going to put too much into the volume right now. Price always comes first and foremost. So again, so far price is bullish, and we just have to keep an eye. If we continue to build on these gains from here and put these numbers in the rearview mirror and burn through those divergences I talked about, bullish. However, if we do start to move back down, we have a couple key levels to watch here. This blue uptrend line, this horizontal line here, which is the previous 2008 highs, these really come in around the same level. Then we have this uptrend line below, and if you try to fast forward mentally in time, just eyeballing this chart, these lines are going to come in around the same area. So we have a confluence of support here, very important support on the S&P 500. And if we take these support levels out on a back test, that will more than likely open up the door for new selling. So again, we may not come in back tests, and that would be very bullish to see prices continue higher. But my guess is something like a move back down here, test this level, and then see where we go. If we come back to back test, that would be an objective area to add on long. If the divergences are burned through, other things confirm. But if we break down, we're probably going to see prices lower. I still favor lower prices with these long-standing divergences. I still favor a correction that will take us probably well below the typical 5% pullbacks that we've been having over the last year or so. But we'll just have to take it as it comes. Alrighty, let's move on to the daily chart and move a little faster here. As I've talked about a lot, negative divergences, very clear negative divergences on the higher highs here. I'm focusing right now on these purple lines. So we have negative divergences in place. I mentioned the other day that we were looking to see those divergences confirmed on what was that, Wednesday. In fact, they were confirmed at the end of the day on the SPY. Yesterday we saw prices close. I'm going to have to pull up. Let's move these down and add the histogram here. Something I wanted to talk on real quick. Okay. The market has now just opened. It's 9:36 a.m. Eastern Time, and we have a reading. I think yesterday we closed at a 0.01, so just barely positive on the histogram. What that means, when the histogram's positive, we have the MACD line above the signal line over here on the MACD. However, that is the SPY. The S&P 500, which is the main index, did show yesterday a negative crossover, and we printed a negative close. Again, I started this video before the markets opened today. I couldn't get it out in time, but we had a close yesterday of 0.1. We can, if you look in the upper left-hand corner of my screen where the box pops up, I'm putting the crosshairs on yesterday's close. It's about there in the middle. In the blue letters, it says MACD H 1226.9. negative 0.01. So I'm not trying to split hairs here, but we did have and have for the last few days a confirmed negative divergence, a confirmed bearish crossover here on the MACD. And if we have a red close today, which I do favor, that will keep those divergences in place. Right now it has a slightly positive reading, but again, let's see what the end of the day, because we're looking at a daily time frame here. So enough on that. I just wanted to mention that the negative divergence is confirmed, and I do put more weighting into the actual index itself than the SPY. The SPY is a tracking ETF, and as an investment vehicle, it has dividends that it spins off, so we go ex-dividend. We have expenses, and the SPY is going to track very closely, but it does not exactly mirror the S&P 500. So that's what we're looking at here. And I mentioned the divergences as I showed. Let's jump back to the SPY. And again, the reason I use a SPY most often in charting is because the majority of traders will trade the SPY. We have the E-mini futures we can trade, but even the E-minis don't track the S&P 500 cash index exactly. So I use a SPY. It shows well. It's clean to chart. It does a better job of showing the gaps than looking at a chart of the S&P 500. And so again, that's where my main focus is with charting. And so what we're looking at here, we had this recent uptrend line break. Prices are diverging, and I also wanted to point out these, the series of these channels have ascending channels with midpoints drawn. You see a series of 3 lines, the middle line just being the midpoint of the channel. And these channels don't go on forever. Somebody asked me yesterday, will this market ever roll over? Is it going to go up forever? Well, we all know there's going to be corrections along the way. And it's hard to nail those corrections. I thought this one would have more legs, and I still do. From the scope and duration of this extent of this most recent channel, I believe there's more downside to come. Summers are tricky and tough trading times. You have super low volume. The market makers, the high frequency trading machines, they just have a field day with retail traders, and you tend to have a lot of whipsaws in this light volume market. And I think what we saw here are probably a lot of shorts pile in on this breakdown. We were already at the time we were at multi-year low short interest levels. We saw short interest come up a little bit, abate a little bit, and I can. This isn't opinion. I look at the short interest charts. I'm still waiting to see the latest numbers. They'll come out in another week or so. But I know there was quite a bit of short covering on this last rally. And in a low volume market, it doesn't take a lot of short covering to cause a sharp move in prices. So my expectation is that breakdown, for whatever reason, we fell short, jump back within this channel, but I am looking for another breakdown of the bottom of this channel, defined by this orange trend line, and prices to continue down lower, and I still maintain these additional targets that I have on the S&P or the SPY. I do think that they will be hit. We hit my first target way back here a while ago on the when the bottom of this channel was hit, and again, we look at the. I'm looking at the length and duration of this channel compared to the previous channels. Look at the scope of the ensuing corrections on those two considerably smaller channels, and now we have nice divergences in place. And if we go back on these other two channels, we did have negative divergence in place on this channel, and this was a very steep channel. Although it was much shorter in duration, it was a very steep channel and led to a very steep correction. That was a sharp, very profitable correction to trade on the short side, or a great time to step out of your longs and book some profits. This channel was not as steep nor as long, nor did we have divergences in place, and it still led to a correction. So I will admit I am surprised that we haven't seen more of a correction, and the prices did go on to make new highs, but these are marginal new highs, and we're really not far where we were a couple months ago. So I know that the bubble TV, which I try to avoid like the plague, I'm sure they're cheering these new highs in the last few days. I probably haven't turned CNBC on in over a week, but that's where we're at. Again, we're not much higher than we were just a few months ago. So one other thing to talk on real quickly is, trading's all about risk reward, and most importantly, knowing when to trade and knowing when not to trade. I'm making a bearish case here, as unfortunately I have been for a while. I've had bear goggles on for pretty much most of 2013, and the first half of 2013 has been my worst performance that I've had personally, and by far on the site from the picks and everything else in years. So hopefully the second half will be a lot better. But let's just take a look at common sense. And common sense tells me you don't have to be shorting this market now, but to be long and adding long exposure here in lieu of everything I've mentioned, the extreme short interest, the extreme bullish sentiment, divergences in place. And let's look at a very simple tool or very simple metric. It's the RSI, how overbought or oversold the market is. And most of you know that if you're using an RSI, and 14 is a standard reading on a daily time frame, 70 level is defined by this red line is overbought, and anything 30 or below is oversold. So typically you want to go long. Let's use some arrows here. When the RSI is overbought, this is when you want to be looking to book profits on longs, and at the very least, if you miss the rally, this is not a time to be adding long exposure, because usually once the market becomes overbought, and yes, it can stay overbought for a while. So it's often not your first overbought reading, but when you see these consecutive overbought readings, and especially a declining or diverging, RSI, that is when you get corrections. So you don't want to be going long in this area. If you miss the move, you hold off and you wait for this pullback. Active traders or more aggressive traders, this is when you want to start adding short exposure. You don't want to wait for, depending on other people's metrics, wait for confirmed downtrend, because by a lot of the longer term metrics, you don't get a confirmed downtrend until the move is almost over. So you have to be pretty nimble on the short side. But again, my point is, overbought is typically a time to be booking profits on your longs, not adding long exposure. And if you are comfortable on the short side, that's when you want to start either adding short exposure or getting your setups ready, getting your ducks in a row, and being ready for a confirmed breakdown or some sort of sell signal that you're comfortable with. So again, overbought can continue to become overbought, but more often than not, you get the corrections. So now, on the flip side, when do you go long? Well, it's that simple. When the RSI is oversold, when you reach that 30 level, rarely, especially in an ongoing larger bull market that we're in, that is when you want to start getting long. It's times like this down here. Let's again use these arrows. Oops, wrong one. but I think you guys can see when I figure this out. So you see when you get down here to these 30 levels, this is when you want to go long. Now, something interesting to note, and another reason why I don't think that this correction is over, why I think this was the first wave down of more to come. This is the first time in the last couple of years, and I'm sure if we go back even farther, we'll see this, where we've had such an extended overbought run and the correction didn't even bring us down to technically oversold levels. We fell well shy of the 30 level. So I would be surprised to see this market break out and continue on and run to new highs without having alleviated or worked off these overbought conditions and had a nice flush out. These oversold flush outs, what they tend to do is bring in more bears, more shorts, which provide fuel for these long sustained rallies, and they also shake out the weak hands on the long. So that's the sort of my thought process on the dynamics of the market right now, and why, even if we don't have a correction here, and even if it takes weeks, I'm more apt to stand aside this market than I am to aggressively chase longs at this point. Okay, guys, I'll speed things up here. This is a 60-minute chart of the SPY. Very simply, we had this few months back. Earlier this year, we had this clear uptrend line / rising channel. Divergences were in place, and that led to this nice, very profitable downside correction, profitable if you were short. And what do we have here? A very clear uptrend line, about the same scope and duration on that uptrend line, even the same slope. In other words, they moved up at about the same angle. And we had a breakdown here. Prices have gone on to make a new high, but to me, and this again is my analysis, that is not an all clear signal with these divergences in place that we see here, solid negative divergences. Yes, we do need to see the MACD. I'm sorry, we need to see this MACD turn down soon. Prices could continue to move higher. That is a possibility, and if so, we see the MACD and the RSI move higher. And if they take out these trend lines, or I should say, these trend lines can be adjusted upwards until they're horizontal. I'm sorry, but once we take out these previous reaction highs here and here, then those divergences are negated, and that's a 60-minute time frame. So, all right, just wanted to point that out, that we still at this point have negative divergences in place, and we've only made a slightly marginal new higher high than where we broke down here. And that to me is very common. I'm not expecting a back test at this line. In fact, that is such a steep uptrend line. If we did back test, it'd be way up here, and that would definitely burn through these divergences. So my expectation is that we roll over today or next week. Otherwise, these charts start looking a lot less bearish, and we just have to, or at least personally, I may have to sit on my hands a little bit longer. Okay, here's the QQQ weekly chart. Let's just take a quick look. I'm going to pull the volume, expand the volume a little bit here. We've just seen volumes just continue to taper off here. So I don't know who's buying this market anymore. The retail trader is pretty much out of the market at this point. And that is a concern, to see prices wedging higher while we continue to taper off in volume. Just about everything, whether it's an oscillator, indicator, volume, just about divergences across the board everywhere. Something real quick to go through again. I mentioned earlier how divergences, the ensuing correction or bounce, whether it's positive or negative divergence, is the ensuing move is typically in line with the divergences. So we look back here from this point. I had these divergences drawn a little longer. Yeah, we could do that. Well, we see a correction here, and that was at this point right here and here, where the MACD and the RSI had made a lower high. That was our first divergence, and yes, we had that small correction. That was a small divergence, led to a small correction. Prices continued to build higher. Let's see here. Let's draw that out because it's not fully shown here. So we continue to make a higher high. We had pretty much flat line divergence. We definitely had negative divergence on the PPO, And again, we had a correction, and of course this correction was larger than the last one. Reason being the divergences were larger. So this all goes back to what I spoke on about the you know the more pronounced or the longer in duration these divergences are, typically the steeper the correction. Now we have this large rising wedge pattern on the Qs. Prices are contracting, they're pushing higher, momentum continues to wane, the RSI continues, divergences continue to build. Each successive peak, as you can see here, these three peaks were lower against three higher peaks in the QQQ. The PPO as well, diverging clearly. So my expectation, if technical analysis plays out the way I expect, we're looking at a downside move in line with the scope of these divergences. So that's something I wanted to point out. Those are my thoughts on the market, and this is why I continue to maintain a longer-term bearish outlook for the remainder of 2013. We need some solid sell signals. When are they going to come? I don't know. But again, I'm being very cautious. I am still, I tend to keep a balanced portfolio most times. Sometimes I'm net short, sometimes I'm net long, but I like to trade the best looking patterns long or short. But lately I'm more apt to book profits on longs and than I am to add a lot of long exposure at this point. This is a daily chart of the Qs as we wrap this up. Here were some long-standing, very clear divergences back in 2012, which led to this very powerful and very profitable correction if you traded that on the short side. Right now on the Qs on the daily chart, we have clear negative divergence, although it's not as long-standing, and this is my initial target, the trend line. I feel fairly confident that this target will be hit. Don't know if we're going to push up or flounder around for a few more weeks, but at some point this year, I believe prices come back down to this trend line. And with these divergences building, yet to be confirmed in the Q, we had a bit of a whipsaw here, but my expectations is that prices do turn down soon, confirming these divergences, and that would bring us down to, it depends how quickly we come down to exactly where that trend line would be hit, but somewhere I'd say around the 72 level, that would be my target for the Qs within the next few months here. Okay, folks, this has been Randy Finney with Right Side of the Chart, and I hope you enjoyed it.